very much, Paul. I was really impressed by the way Paul can say, I'm delighted y'all are here. He's so smooth, you know. I was going to say, I'm delighted you all are here, and just to reflect my northeastern background. But it is fun to be here. It's great to be in Atlanta. It's great to be with a lot of friends. And it's great to hear Paul say such nice things about me, because I've always admired him. So if he actually thinks I did anything for him, I feel great about that. I'm going to try to give you an idea in a very brief time of why we had a financial crisis and why that is important. Paul mentioned that I have written a book. It'll be out in January, and it's about what caused the financial crisis. And you might say, well, who cares? I mean, the financial crisis was in 2008. It's all over. I mean, we're not recovering very well. That's the point we have to focus on a little. We're not recovering very well, but nevertheless, it's over. Yet it's very important. It's important for two reasons. One is because we want to understand why we had a financial crisis so that we don't have another financial crisis, and caused by the same stupid mistakes. And the second reason is that the financial crisis produced what Paul was talking about, which is the Dodd-Frank Act and the regulation that it has imposed on the U.S. economy. Paul talked about one aspect of the Dodd-Frank Act. I think it's the most important aspect. That is the power that has now been given to the regulators to regulate the way the capital markets and the financial markets work. We have to do everything we can to restrict that power, but it was the narrative about the financial crisis that is responsible for the Dodd-Frank Act. And that's what I'm going to talk about, because, as Paul mentioned, I was on something called the Financial Crisis Inquiry Commission. It was 10 people appointed by Congress, 6 Democrats, 4 Republicans. I was one of the Republicans. And the idea was to determine, at least that was the charge to the FCIC, was to determine what caused the financial crisis. Well, it was actually a whitewash. It wasn't really a serious inquiry. The person who was the head of it was very close to Nancy Pelosi. The idea was simply to provide a basis for what Congress was going to do anyway, which was to use the financial crisis to give much more power to the government. So although I tried during the time I was there to get them to look at other things, and some of the things I'm going to talk to you about very quickly today, no dice. There was no interest in looking at anything else. And when they reported in January of 2011, when they reported that the financial crisis was caused by insufficient regulation of the private sector, greed on Wall Street, and things of that kind. And so if that is the narrative that you assume for why we had a financial crisis, well, of course, what the government is going to do afterward is to give much more power to the regulators. I have been arguing, and I dissented from the FCIC's report because I believe there was an entirely different cause of the financial crisis, and that is the government's housing policy. And I'm going to race through this, I'm afraid, but I think you'll get the general gist of what I'm talking about. This is what the housing system in the United States looked like when we got to 2008. Oh, I don't know how this thing works. Where'd you get that pointer, Paul? What is this? Is that
upper right
in the middle? Oh, that. Okay. Well, it worked for you. Never mind. If you look at this chart, you can see that most of the mortgages in the United States were being securitized. That is, they were being bought, turned into pools of securities, and then pools of mortgages, and securities were sold backed by those pools by GSEs, government-sponsored enterprises, and that's Fannie Mae and Freddie Mac. There are a lot of refinements in this that I'm not getting into, but I just want you to see what was happening in the markets at that time. Here's banks, which we mostly think of as the ones that are making the loans. But in fact, Fannie and Freddie are buying these loans from banks and other originators of loans, and they are selling them out to investors all around the world. Okay, In 1992, the U.S. government decided that it was very important to make sure that there was more credit provided to low-income borrowers for homes. And they established something called the Affordable Housing Requirement. And those were imposed on the GSEs, that is government-sponsored enterprises, Fannie Mae and Freddie Mac. Now, they were told in the original legislation, 30% of all of the mortgages you buy from banks and other originators have to be made to people who are at or below the median income in the places where they live. But if you look at this table, you can see that it started to the percentage, the quota on Fannie and Freddie increased year by year until by 2008. And if you're thinking about 2008, you know this includes the Bush administration. This is not just the Clinton administration, 1992 and through the 90s. It includes the Bush administration. By 2008, 56% of all the mortgages they bought had to be made to people who were at or below the median income. Now, how do you get a good prime mortgage when 56% of the people who you have to sell, whose mortgages you have to acquire, are below the median income, and in many cases, because there are other standards here, below 60% of the median income in the places where they live? Very, very difficult. So as these standards got tougher and tougher over time, the quota increased, the Fannie Mae and Freddie Mac, who were the major dominant parties in the market, had to reduce their underwriting standards. They had to start taking mortgages with 3% down payments, in some cases 0 down payments, and they started also to erode the kinds of things like FICO scores, which is a standard credit measurement score that's used in the market. That happened over and over again up until 2008, until by 2008, these are the numbers on June 30, 2008, 17 million loans out of the total of 55 million mortgages in the United States, about $2.5 trillion, were subprime. If you look at all of the mortgages together, including the total federal government, of which Fannie and Freddie were the biggest, the total was almost 24 million, which is about 76% of all mortgages in the United States, June 30, 2008, were made to people who had a great deal of difficulty paying for those mortgages. I can explain in the book, and here, if I had time, I could explain why this was true, why we had this happen, but this is the key number. 76% of all of the subprime mortgages, which were a total of 31, almost 32 million, 76% of those were on the books of the federal government, principally Fannie Mae and Freddie Mac, on June 30, 2008. This is extremely important to understand, because that explains where the demand for these mortgages was coming from. It wasn't the private sector, it wasn't the banks on Wall Street, it was the federal government who was buying these poor quality mortgages. That's why the government is responsible for the financial crisis. So, I just want to show you what all this really means. This is a table for default rates on mortgages that were purchased by Freddie Mac in 1999. The default rates on these were the best mortgages that Freddie Mac bought between 1999 and 2011. But we're just looking at between 1999 and 2007, that is, during the period when the market was in pretty good shape. And you can see what happens. A prime loan, which is up at the top left, a prime loan with good FICO score, good down payment, and a low debt-to-income ratio, the default rate we'll call as 1, but it was really less than 1%. But if you remove any of those things from the standards, that is, a lower down payment or a lower FICO score, you get much higher rates of default, including down here, say, 7 times. Actually, this is about 14 times the loss rate on a prime loan. So when Fannie and Freddie reduced their underwriting standards so that they were no longer buying prime loans substantially and had created for the entire U.S. a system in which 76%, first of all, half of all poor quality mortgages were subprime, and 76% of those were on the books of government agencies, you can understand how we got such a weak mortgage system in this country. So let's see what else. This is what happened then in 2007 when the bubble that had been created by Fannie's activities began to deflate. This is the growth of the market up to this time, and then there's a crash. This is what resulted in the serious losses for so many financial institutions. This is why we had a private sector financial crisis, because all of these mortgage-backed securities and other kinds of securities that were based on mortgages declined substantially in value, and the securities based on those mortgages declined substantially in value. So all of these institutions then were holding mortgages or mortgage-backed securities that had very little value. So they were looked at in the market, all the institutions were looked at in the market as though they were very weak and potentially insolvent. As a result of that, as a result of the narrative that it was the private sector and not the government that caused the financial crisis, we got the Dodd-Frank Act. What's so bad about the Dodd-Frank Act? Well, Paul told you some that are bad about the Dodd-Frank Act. Talked also a little bit about Obamacare. But my view, and what's in the book, is that it's the Dodd-Frank Act and all of the costs and uncertainties that it has imposed and will continue to impose on the U.S. economy is the reason for the very slow recovery of this country's economy from the recession that we had that ended in 2009. This is our recovery this time. This is the average of all prior recoveries since the 1960s. So you can see that something major is different about this recovery from every other one we've had. And then I'll just add one more thing to, we have to give you guys some time for questions, I'm sorry. But I just want to add this one chart because it fills in a little bit further what Paul was saying. Paul was talking about the control that the Financial Stability Oversight Council, in other words, the regulators, will have over the financial system. And I want you to understand that regulating the banks is not that important. This is what distinguishes the United States economy and the United States financial system from every other financial system in the world. In Europe, it's a bank-centric system. They rely on banks for financing. In the United States, we rely on the capital markets. And one of the reasons our economy is so dynamic is that the capital markets continue to force change because of asset managers and others, and underwritings and public offerings of securities and public offerings of debt continue to force change. And if we allow a regulatory group like the FSOC, the Financial Stability Oversight Council, to gain control of our capital markets, we will stop the growth in this country. And it's already bad, as I showed you in the earlier slide, but if we allow it to happen, as Paul was suggesting, our growth will even be slower. And we know from looking at the newspaper headlines every day how this is affecting people in the United States and their views about what the future holds for them. And when we read in the papers about differences, wide differences in income, when we read in the papers about people no longer believing that their children will have lives as good as their own, this is very dangerous, because this country has always relied on economic growth to bring up all the boats. When the tide comes up, it lifts all the boats. There are jobs for everyone. And so it is exceedingly important that we keep those capital markets free from the government controls that have actually stunted the growth of the banking system. Starting from here, you can see it just can't grow as fast as the securities and capital market system has. So that's all I have time really to talk about with you. I want to leave some questions for Paul and for me if you have it. Thank you very much.